Okay, Chapter 3, the adjusting process. So, as we've mentioned in Chapters 1 and 2, we're doing the accrual basis of accounting. It is not based upon the receipt of cash or the payment of cash. It's required under generally accepted accounting principles, and so um, under the accrual basis, adjustments need to be made at the end of each period in order to true up the account balances and present a full and complete picture of revenues earned and expenses incurred. Under the cash basis of accounting, it's just based upon cash in and out. So this is how your childhood lemonade stand would have worked. You've got a cigar box and people come by and buy a lemonade for a quarter and you put it in the box, and at the end of the day, if you have more than you started with, then you made money. So that's the cash basis. Some charities use a cash basis of accounting, and you as an individual taxpayer pay your taxes on a cash basis of accounting. But for businesses, we rely on the accrual basis. So revenue recognition is when all of the steps have been complete, the services have been delivered, or the products have been received. So it is normally measured as an asset, debit to an asset, either cash if your customer is paying you in cash, or if you're sending out a invoice, then it's an accounts receivable. Expense recognition is based upon the matching. We want to make sure that we capture all of the expenses that are incurred in order to generate the revenue in that period. So we want to make sure that we are calculating as true a net income as we can. So this requires some adjusting. So far, we have just been analyzing business transactions as they happen. We've been classifying those business transactions into at least two accounts under the double entry method of accounting. And then we've been recording a journal entry and then posting those journal entries to the ledger accounts in order to come up with the trial balance at the end of the period. So this trial balance is now going to be referred to as the unadjusted trial balance. And then based upon Chapter 3 here, we'll go through the various types of adjustments. So some examples is that we've been recording supplies as we purchase them, and so that asset account has been increasing in value as we buy the supplies, but we use some of the supplies during the course of business. So at the end of the period, we need to go in and ascertain how much supplies are still unused in the shelf, in the supply closet, and then record the amount of supplies that we use. Another one is unearned rent. We receive rent in advance from a tenant, and we record that, but as they occupy the space, then we get to earn the revenue and add that to the income statement. There may be unrecorded expenses at the end. You have employees that work. The month may end in between pay periods. So we have wages and salaries that have been earned but have not yet been recorded. You may have revenue that is earned right up to the last hour of the day on the last day of the month, and you need to record that revenue. even though a invoice may not have been generated for that revenue. So there is an adjusting process that goes through every time we need to produce financial statements. And the adjusting process is always going to affect at least one revenue account and one income statement account and one balance sheet account. So it will always have either a debit to an expense or a credit to a revenue, and then a debit to an asset. Well, you could have a debit to an asset or a credit to an asset in the same with a liability. You could be increasing or decreasing a liability account. But you'll always be either increasing a revenue or increasing an expense. So increasing an expense with a debit and increasing the revenue with the credit. There are two types of period ending adjustments. There are accruals and deferrals. So an accrual occurs when a revenue has been earned or an expense has been incurred that has not yet been recorded. So in this case, no cash has changed hands, either prior or on the date of the transaction. So we have earned a revenue and we're now recording it, or we have incurred an expense and we're now incurring that. So examples is a revenue that has been earned. We debit accounts receivable and credit that revenue. So this is the revenue that we earn on the very last day of the month, or even after hours. A revenue can continue to be earned up until midnight, or when our shipping and receiving dock closes down. And expenses are continually incurred up until midnight of the last day of the month. Deferrals, cash has changed hands. So if you have a deposit or a prepayment from a customer, then you have unearned revenue. So this is the case of an airline that has accepted your cash when you made a reservation. It's a liability for them until such time that you board that aircraft and they take you to your final destination. At that point, the revenue process is complete and they get to record the revenue. A prepaid expense, this is prepaid rent, prepaid insurance, the case of supplies. I also throw in fixed assets here. Property, plant, and equipment is a type of a prepaid. Cash has changed hands. We've already paid for the asset, but now we have used up a portion of it and need to record the expense. So unearned revenue, the initial entry was we received cash for services that we're going to perform in the future, and now that future has come and we need to record the revenue. We paid cash when we bought the insurance policy in prepaid insurance, for example, and now a portion of that policy has expired and we need to expense it in order to match it to the revenue that was earned. So as I said, the initial ledger account balances at the end of the period is now the unadjusted trial balance. And to that, we're going to make a series of one of these four adjustments. Remembering once again that the adjustments are going to be either one income statement account, one balance sheet account. So we signed an agreement to provide services at a rate of $20 per hour. At the end of the month, we have provided 25 hours of service, so we multiply that by the $20 per hour. We get $500 worth of accounts receivable and take the fees earned of $500. So we're now going to have an expansion of our chart of accounts. We're going to add a accumulated depreciation. This is a contra asset account. We're going to add an accounts, well, we've had an accounts receivable. We're going to add Y'all know all these are the same. So we now have rent revenue. We're going to have some insurance expense for the first time. We're going to get something, the depreciation expense, and these are all part of our 4 adjustments. So accrued expenses, as I said, the employees are paid bi-weekly on a Friday. December 27th, it was a Friday. So the 28th was Saturday, Sunday, Monday, Tuesday. Tuesday is when the month ends. So we owe for that Monday and Tuesday $250 in wages to our employees for December, even though they're not going to be paid until the second Friday in January. So we're going to debit wage expense and then create a wages payable, a new liability. So when we turn around on January 10th and pay that, we'll wipe out that liability. We'll pay the cash to the employees of $1,275, and only the remaining $1,025 will be attributable to January wages. So here's just a depiction of it. So we had Monday and Tuesday that fell into December, but it was in a January pay period. Okay, so splitting it between. So we got 3 months worth of rent back in December 1st. Of $360, and now December has gone by, so we've now earned that December rent. So we're going to reduce the liability by the $120 and take rent revenue for that same amount. Supplies, we have a total in the supplies ledger unadjusted of $2,000. We go in and we count and we ascertain that we have $760 left of that $2,000 balance. So that means we used up during the month of December $1,240. We're going to take the expense, debit supplies expense, and credit the supplies account, bringing it down to its actual balance of $760. Insurance, we bought a insurance policy for 12 months, $2,400. That's $200 per month, and 1 month of that has now expired. So we're going to debit insurance expense and credit the asset by $200, bringing it down to the $2,200 value of the remaining 11 months in the insurance. So fixed assets, as I say, are a type of deferred expense. We've already bought the fixed asset, we bought the property and plant and equipment, and now we're going to systematically spread the cost of that asset, the net cost of that asset, over its useful life. And this is called depreciation in the case of a tangible asset. An intangible asset like a patent would be amortized, and then a natural resource such as coal or oil or timber would be depleted. So depreciation expense is for tangible fixed assets. So we're going to use the debit to depreciation expense, but the credit is to a negative asset. We're not going to credit the original equipment or building or computer account. We're going to separate that out so that the readers of the financial statements know an idea as to how much useful life is left in our property, plant, and equipment. And so that's a negative, it's a normal credit balance, but it's an asset, and that's called a contra asset account. We do that for everything in fixed assets, everything in property, plant, and equipment, with the exception of land. Land is considered forever. It doesn't depreciate. So here's the entry. We've determined that it's $50 for the office equipment per year, per month. And so $50, it's a 3-year life, obviously. So $50 to depreciation expense debit, and then a credit to that contra asset account. Subtracting the accumulated depreciation from the original cost of the asset gives us book value. It is not a fair market value. It's not what you can sell the asset for. It is what value we placed on the balance sheet based on historical cost. So the adjusting process is that we have accrued revenue and expenses. These are items that no cash has changed hands. And then we have deferred revenue and expenses. And this includes the depreciation on fixed assets. So here's a summary of all of the adjustments that were made at the end of the period. We then book those into each of the accounts. So accounts receivable, supplies, prepaid insurance, accumulated depreciation, the wages payable, unearned rent, and so forth, on down to the depreciation expense. This then gives us the adjusted trial balance, and that is what we would use to produce financial statements. All right, that's it for Chapter 3 Introduction.